Ready, set, and we are live. We are live, coming to you live from the studios in Round Lake Heights, Illinois. This is your Insurance Corner, and for the next hour, Sean and I are going to take you on an excursion of something that's going to make your eyes water, folks. Yes, we are going to talk about taxes, because it is tax season, and we have been getting a lot of questions in our office the last couple of weeks on this thing called required minimum distributions. This little concept is going to sneak up on you when you are 72 or 73, depending on when you turned, and I will get into the specifics momentarily. But this is an additional income tax on top of whatever else you're paying, because the government requires you, ergo required minimum distribution, to pull money out of your IRA, your 401k, your pension plan, your annuity, wherever you have money that is an IRA. Notice I didn't say Roth IRA. I'm talking about traditional IRAs, including your 401ks. And it requires you to take money, account for that money, and then pay a tax. But we'll get into the specifics here in a minute, but without further ado, the man, the legend, the way of life, the soothsayer of soothsayers from Dayton, Ohio, Sean Hauser.
Hey, Bill. Good evening. I heard you open up talking about Texas, and of course, all my exes live in Texas. Get it? All right.
Yes.
I'm here all night.
Yeah, me too. Yeah, me too. Let me just say until we get. I'm going to go into some welcome stuff like we normally do here, Sean. But I'll say at the outset, Sean and I are not CPAs. We're not tax accountants. We're not. This is not our specialty. But particularly what I do, I'm not sure what in the context of what Sean does. But certainly what I do, this thing comes up. Because if you have an IRA and you're working with me and you have an annuity of some kind, whether it's a Roth or a traditional, and it's an IRA, you are hearing about required minimum distributions. And you start to go into panic mode because you're like, wait a minute, I didn't account for this as a part of my overall strategy for my retirement. Well, I'm giving you a heads up, folks, that the RMDs are coming. It's like a colonoscopy without anesthesia, and you're going to like it, whether you like it or not. How about that for a metaphor, Sean?
One I could probably try to forget, but when I used to work in retirement plan operations, RMDs would pretty much encapsulate all of my days in the last quarter of the year, because depending on when they start, you have to show, once you're in the distribution mode, you have to show a distribution from your retirement plan, which comes out on a 1099-R, and you have to report that in your taxes, because if you fail in your obligation to take money, once you have to start, that becomes what they call an excess accumulation, and then the tax penalties are going to get stiff.
Yes, absolutely. So we're going to get into that, folks, here in a second. This is a big deal. And I'm going to get into where the money can come from, because curiously enough, Sean, you have to, you may not have to pull the money out of the IRA. The government doesn't care where the money comes from, as long as you pay the tax and recognize the income. But we'll get into that in a minute. In the meantime, just a couple of little footnotes. I am assuming, Mr. Hauser, that you did watch the Super Bowl this weekend.
I watched the Super Bowl and had hope until the last maybe
Second?
3 minutes.
Yeah.
Yeah.
I go ahead.
I wanted the Niners to win.
I honestly did too. I wanted it. Not so much because I was a thumper for the 49ers per se. It would have been a great story for the guy who was Mr. Irrelevant, who was the quarterback, Purdy, on the 49ers.
Purdy.
He was the last guy in his selection class to be drafted in the NFL. And the kid was the starting quarterback in the Super Bowl. And that would have been a great story. And I still think it's a great story that this kid came from nowhere, literally nowhere, and is performing at a very high level. And I got to tell you, Sean, I kind of felt like he played better for more of the game than Mahomes did, until it counted in that last quarter.
Yeah, watching Brock Purdy, an Iowa State Cyclone, right?
Yep.
So he didn't come from one of the Tony colleges that all the quarterbacks seem to come from. He was also, I believe, wasn't he the third string quarterback this year? And made it into the starting position because there were other injuries?
I don't know if it was this year, but maybe a couple years ago, Garoppolo was the starting quarterback, and he got hurt. Right. Then Purdy went in, he got hurt, and I think this might have been in a playoff game or maybe in the Super Bowl. He got hurt, and then they ended up with the third-string quarterback playing in that game. I don't know about this year, where Purdy started and where he ended, but he certainly ended as the starting quarterback for a team that made it to the Super Bowl. There was another part of me though that I kept fighting it, but I found myself rooting for the Chiefs too, and I can't explain it. But I didn't have any skin in the game, so I just want a good game, and we got an exceptionally good game, I thought.
Yeah, I thought it was a fantastic game. And it showed a lot of heart on both sides. And I think the reason why I really wanted to see the 49ers win is because I'm just sick of commercials about Mahomes and McKelsey and Taylor Swift.
Yeah.
Give me a break. Let's watch some football. Nickelodeon had a good show on TV. When the guy would catch a pass, they'd slime him or tackle him and stuff would squish and come out of him. Actually made it fun.
That actually is pretty funny. I'm going to see if I can find that cartoon and watch it. That's actually kind of funny. I don't disagree with you. It's Mahomes this, Mahomes that. It's Travis Kelce this, Taylor Swift that. There's a big part of me is like, leave those two people alone. They just happen to be, they happen to be exceptionally gifted at what they do. They happen to be dating. Guess what? There's millions of people around the world that are doing the same thing and are gifted in their certain industries or environments that they do. I don't see the freaking media, chasing them down going, hey, look at me, look at me. Half the time I look at these media idiots and I want to say, notwithstanding that I'm on the radio, and say, who checks you at the door, man?
Yeah.
So yeah, but it was a good game, and I just wanted a good game. What was funny is we got to the end of the third quarter, and I looked at Sal. We were at a friend's house, and I'm like, do you want to leave at the fourth quarter? And about 5 minutes in, I look, and she's like, we'll stay. So I'm like, okay. And then we got one more quarter to play. After that, we had overtime. So, but it was a good game. We had a lot of fun at our friend's house. Lots of good stuff and food. Did you have people over, Sean, or was it just you and Kelly?
Just Kelly and I watched the game, and, it was end of the third quarter, and I said, I'm going to bed. I'm going to go upstairs. Mm-hmm. She's like, really? The game's still on. And I said, sure. So I went upstairs. Of course, I watched it.
Right.
And then it was coming down to the end, and I'm like, oh, please, sneak through. Mm-hmm. Just let the Niners win with 3 points. And they tie it up, and yay, overtime.
Yep.
Crap.
Now, just one thing about that. If the kicker on the 49ers had made his extra point, the 49ers probably would have won the Super Bowl.
I bet you that guy is just dying right now.
Yep.
And
he's a rookie on top of it, So, every play means something. I commented during that fifth quarter. I'm like, the linemen have been out there on both sides all game long. They have to be exhausted.
Oh my gosh, yes.
Yeah, so I mean the running backs and the ends, they get to come in and out. Yeah, they're running sprints, but then they come out and they can rest for a couple minutes. The linemen don't get that luxury. Neither does the quarterback to some degree. So it is Valentine's Day tomorrow, Sean. Since you are a brand new husband this year, what special entrees are you providing for your lovely bride?
Oh, she might be listening to the show, so I want to be careful.
Okay.
Which is to say, I hope that it gets delivered tomorrow.
Yeah, okay. I feel you. Yes. Yeah, I got the same thing. I can't say what is coming. I'm sure she could probably guess because I'm a bit predictable. But on Thursday, we're actually going to go to the theater and watch a play at the Marriott Lincolnshire. So, so I'm kind of excited about that. Sally's got Friday off. She's got some institute day that she doesn't have to be at school for, so she can take the high road. So happy Valentine's Day to all the young and older ladies out there. It's a special day for you, maybe for the guys too, but it's a girl thing, and at least in my world. I did have a friend of mine reach out to me, and he said, "What are you doing for Sally?" And I told him, and he said, "Well, I'm not doing nothing." I'm like, you can buy her some chocolate and one rose. Oh, that's a waste of money. I'm like, well, okay, then buy her a pizza. Take her miniature golfing or something.
See, I thought, I told her, I says, look, you already have the best husband a woman could ever want. What more could you want for Valentine's Day? That didn't go over.
Was that a pregnant pause that I just heard there?
Well, I was waiting to see if, I would get some recognition or some kind of flash of acceptance, and it looked angry.
Anyway, but I this is a shout out to my wife. I love you, my Miss Sally. You have been my lovely, beautiful bride for 32 years, going on 33 this May, and you are still more beautiful today than you were yesterday. So happy Valentine's Day, honey. And to Kelly, happy Valentine's Day. You do have a golden retriever at your beck and call anytime in your house called Sean. He will come to you for anything. So
that means you can put me out in the yard when I'm acting up.
This is true. I'll use that at the staff meeting on this Saturday, Sean.
Okay.
Anyway, last week we talked about income as a part of the equation that, there's so much discussion in the world of finance that everybody's all about assets under management and how much money can you pool into your 401k, your investment account, or whatever. And my attitude as an advisor has always been the pool of money is an ego thing. You should get a pat on the back for, busting your butt for 30 or 40 years and getting money set aside. Nobody talks about how do you unwind all of this. Nobody talks about, this last paycheck is this Friday, and now what? I got this regular thing coming to me every 2 weeks, and now what? How does this work? And now do I have to become, not only an aficionado on understanding what my ins and outs are in terms of my expenses and my outflows and inflows, but now I have to become a bit of a tax expert. Yeah, you kind of do. I hate to tell you, but you have to pay attention to what your taxes are going to be, because if you have an investment account and you liquidate, you're going to have short-term and or long-term capital gains. By the way, did you see what happened to the market today, Sean?
Yeah, I did.
Yeah.
Fears over inflation really drove her down.
Yeah, and it's just a burp for now. I think the worst is still to come. I think we're headed for 2008. I'm just saying. I'm not hoping for it. I'm just saying. $35 trillion in debt, and these idiots just sent $96 billion to Israel and Ukraine. Not that they don't need the money, but we have a border that's open like a sieve. Just saying. We got bigger trouble here than around the world. But going back to the topic at hand, nobody pays attention to the taxes. And the government, in their infinite wisdom, will be coming for you when you start to withdraw your money. Now, between, let's say, 66, when you start to retire, or 67, or even 70, you're just paying your normal income taxes, right? And then you start talking to your friends, or you look at a financial magazine or the AARP magazines that are out there, and this thing called RMD comes along, required minimum distributions. And you're going, what's that? Because you've not heard of it before, because nobody talks about this while you're accruing your assets. Now, some of you may be on top of it, and you're 66, 67, so you don't care. Well, you will when you turn 72 or 73, and it depends on when you turn 72 or 73 as to when you have to trigger this. So, for example, if you turn 72 in calendar year 2023, then you have to take required minimum distributions in calendar year 2024 and pay those taxes by April of 2025. Gets a little confusing, I'll admit, but essentially, once you turn 72, depending on when you turn 72 or 73, there is a calculation that is required. Now, before we get into that calculation, let's talk about the sources of income that are going to be required to be reviewed. So you have your IRAs, and chime in anytime you want, Sean, if I start to go off the wagon here. You have anything that's an IRA, a traditional IRA in particular, or 401k, or a profit-sharing plan. I have a client, for example, that has, she's turning 65 in June, I think, this year, and she's got a couple $100,000 in her 401k, and that is, by definition, it's 401k, but it's an IRA from a practical matter. You have to take into account all of your holdings in IRA, profit-sharing, 401ks, all of them. You have to add them all up. And I've got one client that has 10, Sean, he's got 10 different IRAs. And he asked me yesterday, he said, can I just look at one of them? I said, nope, you're going to have to add them all up. He said, oh my God, you know how much work that's going to be? I'm like, yeah, I get it. I'll help you to the extent that I have, skin in that part of the game, but I don't have your investment account. I just do your annuities. But we have to add them all up. And he said that, and then he said, well, then what happens? I said, well, then you're going to have to go to the IRS calculation chart. And there's a calculation that you have to manage. So first you have to add all of your IRAs to the penny. And there was a question that came up during that conversation yesterday. It says, how does the government know? Well, your IRA manager, whoever it might be, whether it's Vanguard, Fidelity, some 401k, they have a reporting mechanism. They have to report that you have money in a holding pattern in a 401 or profit sharing or IRA or what have you. And that's going to be reported to the government. They're going to know. So you have to add all these things up, and then you go to the calculator and you start to unwind your IRAs. So when you do this, at age 72, for example, I'm just turning the page here on my notes. As usual, Sean, my notes are voluminous on this subject, almost to the point where my eyes want to water. And you're going to have to do a calculation. So, as an example, if you have $100,000 in your IRAs total, and let's just say that you are 80 years old, you've been doing RMDs for a little while. Every year, there is a new calculation that you have to pay attention to. So when you're 80, you take that 100,000 and divide it by the calculation that the IRS requires you, which is your life expectancy. So at 80 years old, you're expected to live another 20 years. Actually, 20.2 years to be specific. You take that 100,000, divide it by 20.2, and you come up with a number of $4,950. And that's the additional tax that you have to pay. Now, remember, Sean, when I was talking last week about the fact that people don't know what they need to live on, so you really kind of have to back into it. First, you find out what your Social Security is going to be, assuming you paid into it. If you worked for the federal government during a period of time, you don't have Social Security, you've got a pension. So that's actually in a weird kind of way. For teachers, same kind of thing. Up until like the 90s, if you started as a teacher in the 80s, you didn't pay into Social Security, so your pensions were that much better. But you have to take account of these things, and you add up what your expense is going to be, what your income is going to be, or what you think your income is going to need to be to meet your expenses. And then the RMDs show up at 72 or 73. At 72, Sean, just to give you a sense of this, let's just say you had $100,000 in your IRA. At 72, you have to divide that number by 27.4. Now, I don't have my calculator handy. I'm sure you've got something there. What's 100,000 divided by 27.4?
3,640. Let's say $3,650.
Okay, so $3,650. Now, that was not an expense that you were expecting to have to pay, right? When you retired, you're on autopilot between 66 and 72, and things are running pretty well. You're fairly healthy. You're able to go around a little bit and travel and do what you want. You're fairly comfortable. And then the RMDs show up, and they're like, the government wants their $3,650 this year.
Well, no, the RMD, if you took 100,000 and you said your life expectancy was what number?
27.4 years.
27.4 years. So the IRS is requiring you to take a distribution of $3,650.
Right. Right.
And then on that $3,650, you're going to have to pay income tax.
Exactly right. So you weren't you weren't that in the context of planning for your retirement, this is going to sneak up on you, and you have to be prepared for it. If you've got IRA money or profit sharing money or 401k money, because the government's going to require you to take that distribution and then pay the tax on it. Now, I asked my accountant yesterday, I said, does it matter where the tax comes from? Do I have to take the money out of the 401k, or can I just assimilate that number and pull it from a cash account that I have? And he said, yes. Now, I haven't, full disclosure, I have not gotten into the bowels of the research on this. I just asked him because he is a CPA. And he said it doesn't matter as long as you pay the tax. But to your point, you had mentioned earlier, Sean, that they're going to require you to pull that money out of there. But I'm thinking, just talking off the top of my head, if you recognize it, but didn't actually take the money, is that a problem? Assuming you're going to pay the tax on let's assume it's $4,000, for example, and you're going to pay the tax on it. Does it matter where the tax money comes from?
I don't think it has to come out. As a matter of fact, when I used to calculate these for folks, if my required minimum distribution was $3,650, I would send them a 1099-R, Code 7, that said they took a distribution from their IRA of $3,650. Now there'll be a tax burden on that, but this just goes in this would be added as income to your tax return.
Right.
And so if you had mortgage deduction and, property taxes and all of that, this would just be more money that you would pay taxes on, but you don't have to take additional money out of the IRA for the tax burden. You just have to take out how much they prescribe using the tables in publication 590.
Now, if you didn't take it out, this is the part I haven't looked into yet. If you didn't take it out, but you recognized it as income and you got a 1099-R, no harm, no foul? Or do you actually functionally have to take it out? The 3650.
Well, how would you take it out? How would you get a 1099-R from your retirement account if they didn't distribute money to you?
Oh, okay. So you do have to take it then, because you're not going to issue a 1099-R, right?
To yourself, no.
Right.
That would come from your IRA custodian or your bank or your investment firm or whomever is the custodian.
Right. So you do have to take it in order to generate a 1099-R. Otherwise, the penalty, what's the penalty, Sean, 25%? Or is it 50?
It becomes an excess accumulation because, again, the IRS is expecting to take that money out. And, again, we're not tax
right.
advisors, but failure to distribute the IRS side didn't take me right to it. But what it does is it counts as an excess accumulation, meaning the IRS is requiring you to take the money out. You didn't take it out, so that money is still in there and accumulating. So at least you haven't taken a distribution in theory. So
right.
Then they're going to penalize you. One, they're going to make you take it out. Two, they're going to penalize you on the additional amount. And 25%. That sounds familiar, but
I think it is 25%. I could be wrong, but this client of mine then asked, does it matter where I pay the tax from? And it doesn't matter. If you want to take it from a cash account, that's fine. But if you took a $4,000 distribution, you have $4,000 in your hand. You don't have a choice. You have to take it out. And if you got $4,000 and the tax is 20%, you're going to pay $800. You net out in that example $3,200. So whether you take the money out of a slush fund cash account, an emergency fund, or you just take it out of the net check or the gross check you got from the rollout from the IRA, it's kind of six one way, a dozen the other. But then he said, Bill, some of my IRAs are in investment accounts where I've got capital gains going and all this other stuff, and do I have to pay attention to short-term and long-term gains? And I said, no. This I can say categorically. If you have an investment account and you've got dividends and capital, long-term gains and short-term gains going on in there, if you pull it out, it's income. There's no capital gains that you have to worry about, folks. It's all income. So it's just the government says you've had tax deferral for 35 or 40 years. It's time to pay us back. And we've got this calculation that's on the web, the IRS website that says pay us or else. So take the money, pay the tax, whether it comes out of your gross check that you pulled out of your IRA or whether you take the money out of a cash account. That's totally your call. Now, if you take it out of an investment account that is not an IRA, then yes, you are going to incur capital gains taxes potentially. If you got it in a Schwab account or Merrill Lynch or Vanguard or whatever, and you have to liquidate a mutual fund or a stock in order to pay the tax, and those are not IRA-driven accounts, you are absolutely now going to pay not only an income tax on your withdrawal, but you're going to pay a capital gains tax on the withdrawal out of your investment account, and now you're going to be a little angry.
Mm-hmm.
So,
yeah, one thing I was just noticing is there is a great, I'm going to praise the IRS, right? But irs.gov is where you can go, and there is a great FAQ document called RMD comparison chart.
Mm-hmm.
Okay, and it answers a lot of those questions you just asked, such as what happens if I don't take an RMD? if your distributions are 0 or less than the RMD for that year, you will be subject to an additional tax equal to 50% of the undistributed RMD.
So it's 50%,
now, that's
not
right
25.
from the IRS website.
Yeah.
Yeah, I had to look that up.
Yeah, I kind of thought when you said 25, but I wasn't going with you, but there was a little birdie on my shoulder going, I think it's 50, but let's confirm. Again, we're not tax advisors, folks, but this is something that's readily available for any Johnny Lunch Buckets that's out there. And while Sean continues to do the research, Sean, it's already 6:30, so we're going to take a break here at 101.5 FM, WLCB, Slade's Corner, Wisconsin. Somewhere hidden in the bunkers in Dayton, Ohio, that's Sean Hauser. My name is Bill Miksch, settled in the beautiful studios of Round Lake Heights, Illinois. We'll be right back after these short messages.